One of the most remarkable features of markets today is that capital is no longer simply chasing growth. Increasingly, growth is actually chasing capital. And so for much of the past 2 years, investors have focused on the beneficiaries of AI, semiconductors, hyperscalers, and software providers. So they've dominated both headlines and also portfolio return outcomes to a large extent. And so that debate hasn't disappeared, but I think a more important question is starting to emerge. Who funds the next phase of AI? Because what started as a technology story is becoming an infrastructure story. So AI now requires data centers, power generation, transmission networks, cooling systems, and huge or massive amounts of capital. At the same time, governments continue running large fiscal deficits, unsustainable deficits. Private markets are navigating liquidity constraints. And investors may soon need to absorb some of the largest public listings in history. So the issue is not really whether AI matters. The issue is whether capital markets can, continue funding the scale of investment now being contemplated within the AI ecosystem. And so that's why I think we're moving into a new phase of the cycle where the first phase was about earnings, and the second phase was about capital expenditure, and now the new phase is potentially market structure. So passive flows, index construction, liquidity, capital allocation, and perhaps more importantly, portfolio construction, because many portfolios that appear diversified, whether it's through equities, infrastructure, private markets, alternatives, may ultimately be expressing the same underlying view, and that is continued AI capital expenditure. So the challenge for investors is increasingly not identifying AI exposure. It's identifying where AI exposures exist without being labelled as such. And that's the focus of this week's Market Signals. These views are mine and do not necessarily represent those of the forum or any of its affiliates.